Welcome to another episode of the Bank Free Blueprint. And today I have with me Michelle Garbus. Welcome, Michelle.
Thank you, Tom. Thanks for having me.
So, Michelle, you are the owner of Real Property Financial, and you do a lot of performing and non-performing notes. First, let me just introduce a little bit about what your background is. I understand that you've been a mortgage broker since 2003. You've worked with, you've done work with turning around companies, .com type companies. You've been a real estate investor since 2006. Is that right?
Yes, that's all right. Yeah, I'm not a mortgage broker anymore. We're actually full-time note buyers and sellers, and we've been doing that since 2012. But I'll tell you that background in terms of all the things that I've done in my mortgage broker career is what's really helped me in the notes business, and it's really what's helped make me successful.
Oh, I can imagine. Maybe so that everybody understands, or that we kind of start from the same basis point. Could you just describe notes in general? So there's performing notes and non-performing, but just if you can give us the context around the note business.
Yeah, what does that mean? Yes, absolutely. So when you get a mortgage on your house, when you buy a house, that's considered a note. So what we're doing is we're buying those mortgages or deeds of trust in some states that are not performing, meaning people are not making their payments anymore. So that's what we're doing. And what happens is, most of you all know, when you have a mortgage, a lot of times it gets sold to other people down the line, and you get these notices that say XYZ company now owns your mortgage. And so when we purchase a mortgage, we're the ones that are sending those letters out saying that we now own that mortgage. And we get what's called an assignment to that mortgage. And we also get what's called an allonge, so that we now then own that mortgage. So that's what it means.
Okay, so maybe let's just step back one step there, if we could. So we talk about buying notes, and we say some are performing, some are non-performing. And just, again, so everybody's on the same page, performing notes means that the payments have been made, they're current,
on time,
they have a good track record, good history. Non-performing obviously means that they have stopped making payments, and
right. And sometimes it's just spotty. So sometimes they've made some payments, but not the majority of their payments in the recent year or years.
Yeah.
So typically a non-performing, in order to take any legal action, if you will, has to be at least 120 days.
Okay. 120 days delinquent.
Right. Correct.
Yeah. Okay. So let's go from there then. And let's say that now you are able to buy notes. That's your business. You
right.
buy notes, you either get them reperforming, or maybe you resell them, whatever that might be. But when you're buying, can you just walk through a little bit of the process of what it's like to buy the note, what that process is, and what especially as it might relate to the listeners, if they ever wanted to get into the business?
Sure. Well, what we've done is we've established years and years of relationships with banks and hedge funds and those types of people, and they provide us with a list of notes that they're looking to sell, because they need to get them off their books. Typically, that's the reason why a bank would sell notes. And they sell them in packages, and those packages are called a tape or a pool. And we go through and evaluate that tape or that pool, which is a pretty extensive process, honestly. Obviously, they're not performing, and we want to know as much as possible about the property and the borrower to make sure that if there is any way we can get them performing again, that we are able to do that, because otherwise we would need to foreclose, and probably talk about that later, which we will do. But ideally, if we can get them performing, that is what we would prefer to do. So we go through and we do a ton of due diligence on every single property to make sure that we know exactly what the situation is on that particular note that we're purchasing. And then we decide whether or not we want to purchase that group of notes or that pool or not. And in most cases, you have to purchase the whole thing, the whole group of notes. In some cases, banks and hedge funds will allow you to purchase one-offs, if you will. But in most cases, they're more expensive to do that.
Mm-hmm.
So we tend to be purchasing a group of notes.
Okay, and so with notes, when they come in pools or tapes like this, sometimes they are maybe starter homes, maybe they're commercial, maybe they're mixed, a whole mixed bag of values from high end to low end. And sometimes they may be fairly directed to one sort of one's like typical size of note. Is there any area that you like to focus on? Like, do you go for larger notes, smaller notes?
Yeah.
First position, second position? What is your target?
It really it depends on your risk tolerance, what you would want to target. Obviously, first position notes are going to be less risky than second position notes. So, first position from that perspective is always good. We actually purchase both, but it depends on what our due diligence says and what that looks like. We do purchase residential properties. You can certainly get notes on commercial properties as well, but our focus and our expertise is on residential properties, and so that's what we do. You're absolutely correct. There's a huge range in terms of how much you can buy with notes that are under like $60,000 in after repaired value or over $60,000, whatever that looks like to you. There's a lot of notes investors that really focus on that low end. We don't typically do that. We typically try to focus a little bit more on the higher end, just because we find, and this is something that we actually teach in our class, is that you really want to pay attention to that loan to value. Because if you purchase a note, you're usually getting it at a discount. And if you get it, at 70% discount, and I'm just throwing that out, lower than what that note is worth, 70% of a $200,000 note is a lot more than 70% of a $60,000 note. And so you have room in there to be able, if you have to foreclose, to be able to fix up the property and do what you need. Where on a $60,000 note, you may not have that room. So we like nice properties in good neighborhoods and all of that. And that's what we focus on.
Okay. Now, when we're talking about notes, there's two different values that are a lot of times used as sort of the basis of the value. We have the value of the real estate that is collateralizing the note,
right.
But then we also have the face value of the note,
right.
which
note itself.
there may or may not be a reasonable amount of pay down that's already happened on that note.
Right.
Can you just maybe share some thoughts?
Yeah, no, that's absolutely right. So one of the things that you're looking at is how much is that property worth? So the after repaired value, which most people know it as, you want to know kind of what that house would be worth if you were to fix it up. And then the other one that we look at that is extremely important is what's called UPB, and that stands for unpaid principal balance. And that's, what the borrower has left to pay on that note. Now, a lot of times, in addition to unpaid principal balance, you have late fees and you have past due interest and you have other things, taxes and all sorts of things that could have been paid. But typically when you're negotiating with a bank or you're working with a bank, what you're pricing the note off of is that unpaid principal balance and also that fair market value.
Okay. And when we talk about, you just mentioned when you're buying the note, if let's just say that we have and I know this is just going to, all I can ask for is a range from you on this, but let's say that it's a performing note, performing first position note.
Uh-huh.
There's a typical range of discount that you might expect from something like that. And again, I know it depends on what the market is, what the economy is doing overall, what that area is doing, where the properties are located. But is there sort of a rule of thumb that you aim for?
Well, the range is pretty high right now because a lot of markets, especially around the United States, are doing very well.
Mhm. Yeah.
And so there's actually, on a performing note where you're getting payments consistently, there's actually a number of people that are selling them above par, meaning above the 100% of the UPB,
Mm-hmm.
which can go up to, 110, 120%. You
Mm-hmm.
know, we always look at yield and how much are we going to be able to make on that particular note. And so therefore our range depends on that. And obviously most of the time you're looking at a discount, but in this particular time right now in the economy, you're not going to get as much for a performing note because they're making those payments consistently as you would before. So now you're only getting maybe a 10 or 20% discount at the very most.
Yeah. So let's use that example of at par or maybe just a little bit above par right now in today's economy. Would you venture a guess as to what that might have been 7, 8 years ago when the economy was hitting bottom? What?
Well, performing, again, they're still performing. So you're getting still more of a consistent 80 to 90% discount,
Yeah.
I would say, or not discount, a 10 to 20% discount, but 90% of the UPB.
Sure.
And so, but in the non-performing world in 2008, 2009, you were getting a lot more of a discount because they were not performing at that point. And so at that point, you were seeing anywhere between a 50 to 60% of the UPB or a 50% discount in a non-performing type of note situation.
Okay. And so that's a first position. Now let's contrast that to a second position note that, again, maybe the range of what it might have been 7, 8 years ago versus what it is now. Any numbers?
Well, with second position notes, it's a whole different animal because you need to know how much equity is in the property for your second position. So that's going to be a big play. The other thing is, is the first performing? Because you could have a second that's not performing, but the first is performing. And so you're going to pay higher amounts for whether a first is performing versus one where the second and the first is not performing. And also if the first has where the second has equity in the notes, you're going to be paying more for that particular note. So that's a range too. So if there's no equity in the bankruptcy, they are in bankruptcy and all sorts of things because you have the, you could actually get stripped with your second mortgage if the note is in BK. So all of that plays a huge factor on pricing.
I see. Okay.
So it's a really large range right now. It's anywhere from 10 cents to 50 cents to, to higher even.
Yeah. So we probably won't have time to get into all of them on this particular episode, but we know that there's multiple ways of getting treating a note, even though the two that seem most common and maybe are the most common, one is to get the note back and performing again if it isn't, and the other is to foreclose on the property, right? And so those two, what is typically in your experience with the types of notes that you work with, which direction do you typically find yourself going?
Well, if I can get it reperforming, I will do that all day long, every day, for a number of reasons. One is it's obviously keeping the homeowner in the house, which is what you want to do and what they want to do. So,
Mm-hmm.
if they're willing to work with us, I mean, we can do some great things for them. We can do lower interest rates, possibly. We can increase a term, possibly. There's so many things that we can do for a homeowner to help them out, that if there's any way possible for us to do that, that's what we prefer.
Mm-hmm.
And, for investors, that's the best thing to do too, because you have a loan that's performing on a long-term basis, and your yield overall is actually usually higher if that is the case. But sometimes you have borrowers that are just not going to work with you. And in those cases, if you have to foreclose, you have to foreclose. So we certainly will do that if we have to, and we make it very clear to them that if we have to, we will do that. And in those cases, we'll do that. But there's also other things. I mean, we have borrowers that just refinance us out and pay us off, and we don't foreclose and we don't get them reperforming either. So that's always nice as well. So there's actually tons and tons of exit strategies that you can use. And in fact, when you get a note reperforming, you can then sell a part of it off and get some money up front, which is wonderful. That's called partials. And you, on the foreclosure side, you don't necessarily have to fix it up and flip it. You could fix it up and rent it, or you can do a lot of other strategies with it. So it really depends, first off, on the borrower, and second, what is your exit strategy for that note? Is that something that you want to keep? Is that something you want to sell? Do you want to sell part of it? What does that look like?
Mm-hmm. And again, for listeners, the idea of buying a note is really, it's almost identical. It's very similar to being a lender or a private money lender or a trusted investor who might invest in, might create loans for people in need of loans, generally construction loans or renovation loans and that type of thing. So that's really the reason that people are looking for these types of notes, especially if they're performing. If they're not performing, then the idea of the discount relative to the risk and relative to the amount of either performing notes you get, notes that you get back performing, or that you end up foreclosing on the property. So it's got a lot of moving parts to it, and I can imagine that there's
Yeah, but what's so great about that is it's secured. I mean, it's a note is secured by the real estate, right?
Mm-hmm.
And the investor, if you will, is secured by the note itself. And
Yep.
One of the things that we've done with people that have invested with us is we're actually providing them an assignment just like we get, and an allonge. It's just not recorded, but it's held by a third party. But it's protection on essentially their investment.
Mm-hmm.
And that's works great. And even if the note is a performing note, if you get it performing, it's still secured by that real estate. So it's great because it just helps, have that in your tools, and knowing that you have something that has value there, I guess. If you have to go after something, it's there for you to go after.
Mm-hmm. You just mentioned a term. I want to talk a little bit about forbearance agreements, but you just mentioned the other term, allonge. Could you just describe that?
Yeah. So an assignment is what you get for a deed of trust or a mortgage. So you're assigning that specific deed of trust or a mortgage to us or to the investor.
Yeah. So the bank that you buy it from is assigning that note to you.
Right.
Yes.
Right. But along with that, when you sign a mortgage or a deed of trust, you are also signing a promise to pay, or what's called a promissory note.
Mm-hmm.
So an allonge is something that shifts that promissory note to the investor. So the assignment shifts the deed of trust or the mortgage to the investor. The allonge switches it over from the promissory note.
Okay. So it's so it shifts the value of
Ownership.
the note and the that instrument over to the buyer.
That's correct.
Yeah.
That's correct.
Okay. And so let's talk just a bit about forbearance agreements now. How often do you, or is it just standard practice to use a forbearance agreement? And by forbearance agreement, and certainly share any thoughts you have on it, but really, I guess the way I would describe it is that it's an agreement that forbears you or stop, you agree to stop for foreclosure on a property if certain new terms that you've negotiated with that borrower happen. If they start performing with new terms that you've given them, or even on existing terms, but generally on new terms, you're going to hold off on foreclosing on the property, and you may even discount the note, assuming they perform at a certain level. Do you want to share add anything to that?
Yeah, so typically forbearance agreements, and this is also dependent on states. Some states actually just like to call them forbearance agreements, which, in my mind, they're more a loan mod. But
Mm-hmm.
forbearance agreements are typically shorter in term. So it's giving the borrower kind of a chance to get their feet back on the ground and start making payments and doing some things that show their good faith that they're going to be able to make their mortgage again. So
Mm-hmm.
sometimes forbearance agreements actually lead to a loan modification. So you can
Mm-hmm.
have a forbearance agreement for 6 months or whatever the case may be. And then after that, you go into a loan modification agreement just to get that borrower going again, if you will.
Yeah, and an example that I think of, and correct me if I'm wrong on this, but let's say someone they're scheduled, or the note says they are to make $700 a month payments, but they haven't been able to make payments because they don't have the income to make it work.
Right.
You could negotiate with them, have them make, let's say, $400 a month payments. And if they continue to make those $400 payments for a certain period of time, let's say for 7 months, 8 months, whatever period that is, then eventually you could modify the note to go to that level. But let's say that after month 3, they kind of just fall apart and you can tell they're not really serious about it. Then it would revert back to what the original agreement was. There's no sense in giving a discount or a reduced rate if they aren't making an effort to make it happen.
Yes, that's right. Typically we use forbearance agreements just because some people either lost their job and they're trying to get a new job. So it gives them an opportunity to do that and still keep their mortgage. And so you have reduced payments. Typically forbearance agreements, at least the way we use them, is more for short-term types of things. And
Mm-hmm.
then it would go into a loan mod. And at that point, that's when you would agree to either, again, reduce the interest rate, which would reduce those payments, or lengthen the term, which could reduce the payments, those types of things. And what we do on our loan mods is if the borrower misses a payment, it's very clear even in our loan modifications and forbearance agreements that if they miss payments or they don't get them in on time along the way, that it will convert back to that original note.
Mm-hmm. Mm-hmm. Okay, good. Now, we know that we pretty much understand the upside of a note. Let's say that it's a note that's performing. You're getting a good interest rate on your money, 8, 10, 7, 8, 9%, whatever that rate is. And that's a good return. It's backed by real estate. Or you might have a note that was non-performing. You get it performing, and that's great when things go well. But what would you say are maybe 2 or 3 of the biggest risks in this business, in the note buying business, and how would you mitigate them, or how would you kind of control those risks? What would be your advice?
Well, one thing is that licensing is a big deal now, so you need to make sure, even to buy and sell a note, there's 18 states that you need to be licensed in.
Mm-hmm.
And that's really important to know because there's a couple states that are actually, going after people that are not licensed just when they bought one note. So you have to really know that. And then I would say just the laws in general. We probably spend a day and a half just on laws in our class because it's so important to know those foreclosure laws and the bankruptcy laws and how all that can impact you. And that's, one of the things that we believe is I would rather give you all the information that you need to know the business, because if you know the risks associated with it, then you know what to stay away from, or you know what to look for and how to handle them.
Mm-hmm.
So it's important. So really knowing those laws is just a huge, huge thing.
Mm-hmm.
And the other thing is that I would say not to get too greedy. I think there's a lot of real estate investors that really just want to foreclose on the house.
Mm-hmm.
And in fact, that a lot of times maybe not the best strategy to foreclose on the house.
I agree. Mm-hmm.
And so with foreclosure, people just have it in their mind that they're going to get these big pops and they're going to make all this money. Well, with notes, you don't get to see that house before you get into it. So you need to make sure you buy it right, first of all.
Mm-hmm.
And when you get into it, you're going to have rehab expenses, and you're going to have paid the attorney to foreclose, and you're going to have all of these expenses. So again, you need to make sure you buy it right. You need enough margin in there. But, you also have to be able to fix that up, and the time and the energy that it takes to do that. So foreclosure may not necessarily be the best avenue. It's
Mm-hmm.
one that we do, and, we've done quite a bit, but it's only if we have to.
Yeah. So let's say I want to go and learn more about notes. I'm sure there are probably books out there. There are different ways of for people to learn about notes. What is your recommended approach?
Well,
For somebody who
I
wants to get
definitely
involved?
would take a class, and whether it's our class or anybody's class, take a class,
Mm-hmm.
because the laws are changing all the time.
Mm-hmm.
I mean, every day, and in some ways positively, actually.
Mm-hmm.
So we've but you got to know those laws. So I would definitely take a class and know what you're doing. And honestly, if you're going to start working with banks and hedge funds and all of that type of thing, they're going to want to know that you know what you're doing. They won't even talk to you if you don't know what you're doing. So getting that terminology down, understanding your exit strategies, understanding how to do proper due diligence, understanding the laws, all of those things are just hugely important. You can absolutely read books. There's a lot of stuff online, all of that. But again, things are changing every day. So getting at least the most current information that you can is important.
Mm-hmm. And if somebody wanted to walk down to their local bank, what would they probably hear from the banker if they wanted to buy a note from the bank? Or
they're going to want to know what their experience is. They're going to want to know how much they can invest. They want to know how fast they can turn the tapes around, all of that stuff. So yeah, they will definitely. I've had a guy ask me specifically, what kind of discount are you going to take off the top, because I don't want to sell it at a discount.
Yeah.
So,
yeah.
It depends. And you also have to know which are the right banks, because you can walk into a bank and, here in Colorado, no banks are really selling notes right now because our market is so high.
Mm-hmm.
And so what you're looking for is banks that are writing notes off, that type of thing. And so if you don't know how to do that and how to figure out that information, then you could be walking into a bank and you're just going to be wasting your time. So you also want to make sure that you're targeting the correct banks.
Yeah. And with that, typically the correct banks, from my experience, would be the smaller banks, the hometown banks, not the Wells Fargo, not the Chase, not the the big
Yeah, Wells
five.
Fargo, I don't think is going to talk to you,
Yeah,
unfortunately.
they're just,
Yeah,
they have it's really hard to get to that level, to the
right.
level where I believe you're at, where you have the relationships built with the bigger banks where they will take you seriously because you're able to get in there, you've performed, you're able to buy pools or
Right.
tapes, multiple deals that are pretty substantial in order to make it work.
Right. Yeah. I mean, they'll look at you, and the moment you don't do what you say you're going to do, you're out of there. So with with all the banks, you got to perform. And if you're not set up and you don't have the cash ready to go, and you don't do your due diligence in the time frame you say you're going to do it in, all of those types of things are hugely important.
Mm-hmm. Mm-hmm. Okay, so yeah, this has been really, really interesting. Anything you'd like to add? Anything you'd like to share? I know that you mentioned that you do some training, some courses. If people wanted to reach out to you, any?
Yeah, it's not something that we do full time. We're not a training company. We do real well with our notes, and so that's
Mm-hmm.
what we do. So we do pretty much once a year a training, and I'm thinking we're probably going to do it either the end of February or in March sometime of 2018 is the next one that we're looking to do.
Mm-hmm.
So yes, they're absolutely can contact me if they're interested in doing that. My email is Michelle with one L at REAL propertyfinancial.com. And they can also call me at 303-674-0139, and my extension is 1002. So if they're interested in training, we can talk to them, we can show them what our objectives are, and we can certainly entertain having them join the class. We also have our own fund. A lot of investors just don't have the time that we spend in doing this. The great thing about this industry is there's a whole nother industry that's built up around it, supporting it. So you actually work with a lot of third parties to be able to work on the notes, which is great. But that doesn't mean that it doesn't take some work. And so there's a lot of people that just don't want to do that. So in that case, we'll talk to them about possibly working with us in other ways.
Okay. So we'll put your contact information in the show notes. But before we go, a question. What is one thing that you wish you had known before you got in the business of buying and selling notes? Or what is one thing that that you believe the listeners, that would benefit the listeners?
I would say the most common mistake that I see people make is that they don't realize that you have to be licensed. And that used to be okay. And in some states, you can kind of just do onesie twosie and still be okay, even if it's a licensed state. But there's actually states now that are pursuing that, even if it's just one or two notes that you're buying. So that is not very well known that you have to be licensed just to buy or sell a note. And that has nothing to even do with being a debt collector. So that's just to buy or sell. And so you need to have that information and know that. And I would say that's the biggest thing that I find when I'm talking to people that they don't even realize. And a lot of the places that do train on notes don't even teach that. So it's what I would be careful of.
Okay. And one last question. I always like to ask, what resource, and this is whether it's about notes or real estate or even just business or life in general, what resource could you offer to our listeners that you think would help them in some way, shape, or form? Is there a certain book that you like or a website that you've found really helpful? Or what would be one resource that you think would be good to share?
I think in all businesses, businesses struggle with scaling and doing things in a way that is not just about money, I'll say. And so, we do a lot. As you know, I used to do turnarounds in the .com world,
Mm-hmm.
whether it was a division or a company or what that looked like. And, understanding, what our priorities were and what our goals were, and honestly, what our ethics were and what we were really trying to achieve, that wasn't just about money or just about the product or those types of things, but really making sure that we had an environment that our customers loved and that our employees loved, and that type of thing was hugely important. And so I would say the resources that really helped me with that were the 7 Habits of Highly Effective People.
Mm-hmm.
I would say that E-Myth is a great book, and I think
Yeah.
E-Myth revisited now. And there was also the Rockefeller Habits, which is now called Scaling Up. That they're all really great books that help businesses grow,
Mm-hmm.
but help them grow in a way that businesses want to grow, that keep that integrity and keep the principles of the business that made it that way to begin with.
Mm-hmm. Excellent. Great. No, those are, I read 2 of the books, and I'm going to put that third one on my list. And so what was the last one you just mentioned? The
Scaling Up.
Yeah.
So scaling up was the Rockefeller Habits,
Mm-hmm.
but they have a new version of it now.
Okay.
And it's called Scaling Up.
Yeah. That one sounds, great. Well, thank you, Michelle, for your insight, your advice, your the knowledge that you've shared with us.
Absolutely.
Really appreciate you taking the time. And if anybody has questions, we'll have Michelle's contact information in on the show notes. And if you guys, if you're listening to this podcast and you like it, it'd be great if you'd share it with your friends, share it with anybody in the business that you think would benefit from anything to do with real estate investing or in the real estate investing realm. So with that, it's been another podcast of the Bank 3 Blueprint.
Right.